2026 is shaping to be a great year for Intel stock investors. I know a lot of investors were hoping that 2025 would be a good year for Intel stock investors because the previous few years have been so awful, 2024 included, as the share price is down significantly year to date. Of course, I'm upset about that. I've had Intel stock rated as a buy, and I'm disappointed in its performance. But let's take a look at all of the reasons why 2026 looks like it's going to be a strong year for Intel, according to what management has told shareholders. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So Intel management said that we expect gross margin fall through to significantly improve in 2026. Driven by the vastly improved cost structure of Intel 18A, the return of tiles to a meaningfully underutilized Intel foundry, and operational efficiencies. So you probably already know with Intel, they've invested tens of billions of dollars building the Intel foundry business, where they intend to manufacture more semiconductors, not only for Intel branded semiconductors, but also third-party companies that want to design semiconductors and then have Intel manufacture those chips. Additionally, Intel right now has been outsourcing some of its manufacturing to companies like Taiwan Semiconductor because it doesn't have the necessary capabilities to manufacture all of its own needs. But starting in 2026, they're going to increase utilization of their own facilities and bring back some of that outsourcing and thereby increase utilization, which then increases operating profitability and gross profit margins. The reason bringing back some of those manufacturing will increase profitability is because if you already have a facility that you're utilizing, let's say at just 50%, you're not taking advantage of full economies and scale because you've already built up that manufacturing facility. You're already paying for maintenance. You're already paying for power. You're paying for all of the necessities, labor, etc. And you're not fully utilizing it to 100%. So when you go from 50 to 100 or from 50% utilization to 70% utilization, it significantly improves your profitability because the cost stays relatively flat because you've already paid for the facility. You're already paying for the monthly fixed costs. And then when you increase production, it drives down the cost per unit, thereby increasing profit margin. And that's precisely what Intel is expecting starting in 2026. The CEO says that this was a good quarter on the progress that we had. They got 3 new customers for the Intel Foundry. Amazon was one of them for web services, and then Panther Lake and Clearwater Forest, which are internal use cases for the Foundry. And then they added 2 new external customers to that list. So next year, there's not going to be a lot of financial benefit from that because we're only ramping later in the year. So that's why I said in the beginning of the video that 2025 not looking like it's going to be a strong year for Intel, and it's more looking like 2026. And that's what management said there. Like, they're not going to get some of the financial benefits from all these new deals they signed and the internal use cases because it's not going to start ramping up until later in the year. But they do expect much larger impacts on their 2026 financials as they ramp and bring wafers home, as well as move into better margin structure that they'll have on the Panther Lake with their 18A and across the product line. And of course, I just talked about how they're still outsourcing some of their manufacturing. 2026, they're going to ramp up internal use cases, internal manufacturing for the Intel Foundry, and they expect that to drive significant financial benefit for the company overall. Another reason why profit margins are going to improve is because they just recently invested in the latest EUV technology from ASML, and they're just going to start mixing that in to their production. And so these EUV wafers have a better pricing dynamic and they have a better cost structure on a relative basis. So as they start incorporating this technology, it's going to drive profit margins higher still. One other factor is a new manufacturing facility in Arizona that they just built. And the ramp of that is important as they move to their 18A technology. That comes in volume in the second half of next year. So in the second half of 2025 is just about when it's going to start ramping up in volume. And then you can start to see the benefit of that more meaningfully in 2026. So the first wafers coming out of the volume fab in Arizona will start in the first quarter of next year. It'll ramp up in volume in the second half of next year, and then it'll probably be in full swing in the beginning of 2026. So yet another reason why 2025, it's going to improve, but 2026 is looking like the year for Intel stock investors. So we are absolutely executing on the bringing wafers home strategy that they laid out. That said, they just want to acknowledge that TSMC has been a great partner, but a large percentage of wafers are coming home, and that meaningfully fills our factories, and that also meaningfully improves the margin structure of Intel and Intel products. So I've had Intel stock rated as a buy all year long in this year, and it's been a disappointment, as I've acknowledged repeatedly. It's been one of my worst performing recommendations, and it looks like 2024, although in the last 5 days, the stock price is up nearly 12%. So that was great to hear. And given the geopolitical concerns and the results of the US election, maybe the company and the stock price will get a boost in the last 2 months of this year. Although, like I just highlighted in this video, the positive benefits of all of these investments that Intel has poured into the business is really only going to take shape meaningfully in 2026. That's the year when you can start to realize big surges in the company's cash flow, profit margins, profits overall, revenue, and really start to see the financial positives from all of these investments the company has put in. So this is not a short-term investment. This isn't something that I expect to capture a boost in the near term. This is a long-term, high-risk, high-reward potential investment that could deliver strong shareholder gains in the long run. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.